Stocks on Wall Street pulling back after the Fed, as expected, cut interest rates for the first time in more than a decade, this time by a quarter percentage point. And right now, Fed Chair Jay Powell is addressing the press. Joining us now for analysis and for his outlook on the markets is Art Hogan. He's Chief Market Strategist at National Securities. Great to have you on this particular day, Art. The market reaction, we saw a modest pullback in stocks after the statement and now really pulling back after Chairman Powell started talking. What's upsetting investors when everything was expected?
It really was expected. I would tell you that the first reaction to a Fed meeting and a Fed press conference is usually the wrong reaction, and we'll probably have a rethink tomorrow. And there's a very compressed amount of time between the press conference and the end of the day. So overnight, we'll probably rethink this, but I think it's one of your coworkers that actually asked a question, what does mid-cycle mean? And that actually means this is not the beginning of a long cutting cycle. And Jay Powell wanted to get it across. Insurance doesn't mean we're now in an easing mode. Insurance means we need to lower neutral, and they did that today. And perhaps they have to do a little bit more, but I think the market looked at this and said, hey, what were we counting on? 2 or more cuts for the rest of this year? That might be ahead of itself. And I think the market's saying we need to pull back our expectations. We may be at where we're going to be at for the Fed funds rate for the rest of the year.
Do you think it's possibly one and done?
It could be, and I think it should be, unless and until we see more economic data that tells us that's the wrong place to be. The interesting thing to me has been that since the last meeting, coming into today, all of the inputs, for the most part, have been positive. We've had a better jobs number, durable goods, retail sales. Both the CPI and the PPI came in hotter. So their inputs, their data dependence, has pushed them towards not making a change. And that may well be the case, but we don't know what July looks like in terms of data. And as we get into the next meeting, which won't be till September, there'll be plenty of data to look at.
The Fed also saying that regarding the bond portfolio unwind, that it'll stop shrinking its bond holdings 2 months earlier than it had planned, starting in August. What do you make of that move, Art?
Well, in the grand scheme of things, that means there's going to be on the balance sheet about $80 billion more than we thought there would be at the end of September. So that's the 6 weeks early that we're seeing right now, and that's 2 months worth of unwind that won't happen. So it's not a big deal, but it's a strong message. And the strong message is 3 parts. A, here's another piece of support for this economy. We're not using quantitative tightening. B, we're going to use this balance sheet when we need to. And with interest rates at 2%, the Fed funds rate at 2%, they need another tool. And the third thing is they decided that instead of going 50 basis points, they'd use the 1-2 punch of cutting by 25 basis points and ending the runoff of the balance sheet. I think that's a strong message, but the overarching message is that balance sheet is now a tool, even in modern times, even in normal times, and the Fed is willing to use it.
And partly, perhaps, save some ammunition in case we do get a recession, so that you have some leeway on rates.
Well, yeah, you don't want to use up too much ammunition right now. We don't have a whole lot, right? In 25 basis points segments, we're running out of shots to fire if this economy rolls over. I think the Fed is really struggling, though, with what is actually neutral. With unemployment at 3.6 or 3.8%, and inflation at 1.8% on the PCE or 1.7% at PCE. What is the neutral Fed funds rate? Where should we be? Because those two things don't make sense 30 years ago, but that's what's been happening for the last 10 years. So this is a Fed that's struggling to figure out what the new model should be for Fed funds now that our old models don't seem to be working.
And lastly, Art, before the Fed decision, it was near the flat line. Now S&P 500 is down a little more than 1%. You said earlier that often investors make the wrong move right after the Fed decision. Where do you think stocks are going from here? We're in the thick of earnings season. Now the Fed's finally made that long anticipated decision.
We've got a market that actually is plodding along pretty nicely here. So up 20% on the year-to-date basis for the S&P 500, and still only trading at about 17.5 times the forward 12 multiple. When we look at where we are on inflation and use the rule of 20 and basically take the number 20, back out the inflation rate, and that's the multiple you should have on the S&P 500. It's something that's been around for the last 50 years. So that means we can trade as high as an 18 to an 18.5 multiple if you say inflation is 1.5 or 2%. So we have more room to the upside. That will shrink. That room to the upside will shrink if we escalate with China. I think the worst thing that can happen for this market right now is that we don't have status quo in this U.S.-China trade tension. Because we got nothing done and the administration feels emboldened by an easy Fed, they decide to escalate on that last $325 billion worth of Chinese exports. That would be a disaster. That's the last thing this market does. Barring that, I think we can drift a little bit higher into the end of the year.
All right, okay, but keep an eye on China.
Yeah, exactly.
Thanks a lot, Art, for your analysis. Appreciate it. Our thanks to Art Hogan of National Securities. I'm Fred Katayama. This is Reuters.